Hello friends, welcome to AARDHA. In this video, let's see how to build your ideal mutual fund portfolio based on goals, based on risk, and based on taxes. See, uh, the portfolio mess most investors makes is like this. They invest in 70 to 10 mutual funds, but no clear strategy. All equity funds. They invest in equity thinking that it will give higher returns, but no depth for short-term goals. If you have some short-term goals, then you need to have some depth fund, right? Chasing last year's top performers. Here, top performers in last year may not be giving good returns going further. Overlap. 3 to 4 large cap funds doing the same thing, or 2, 3 short like small cap funds or mid cap funds, which will have similar stocks, right? So avoid such mistakes. No clarity on when to use which fund. These are common mistakes. Now let's see 5 principles of smart portfolio building. See, first principle is goal based planning. Like match each fund to a specific goal like retirement, education, or emergency. For example, if you are building an emergency fund, then go for debt. You can withdraw it immediately, right? As a market returns does not influence this because debt funds invest in liquid things like repos, etc. Also diversification. Mix equity debt hybrid, not just multiple equity funds. Simplicity. 3 to 5 funds are enough. More is not better. Not even 4 or 5. Go with 3. If it is required, then go with 4. That's sufficient. Time horizon. If you are having some goal less than 3 years, go for debt. If it is greater than 5 years, go for equity. Regular review. Rebalance yearly exist under performers. These are three portfolio structures based on risk. Like a beginner low risk takers, equity 20% of the amount to be given for equity, debt 60%, hybrid 20%. Here it is low volatility and gives stable growth. Whereas intermediate risk takers, equity go with 40%, debt 30%, hybrid 30%. Here balanced growth with risk, little more risk compared to these earlier fund. Now aggressive risk takers, but this is to be used only for long term goals. 70% can be kept in equity, debt 10%, hybrid 20%. Here higher returns and more volatility. Portfolio by life stage. If you are younger, like 20s and early 30s, then 70% can be given to equity, 10% debt, and 20% hybrid. Here our focus is long term growth. Whereas in mid careers after 40s, 50% to be given in equity, 30% debt, 20% hybrid. Here focus is balance growth plus stability. Retirement after 60 plus, very less to be given for equity like 20%, 60% in debt, 20% hybrid. Here capital production is more important and some income, regular income. Mutual fund taxation rules as of now. Equity funds, if you are withdrawing them less than 1 year, 15% tax is there. If it is after 1 year, if you are making more than 1.25 lakhs profit, then 12.5% tax. If you are not making more than this, then you need not pay tax. Debt funds, as per income slab, if it is short term, here short term less than 3 years, anything less than 3 years is considered as short term. Whereas for long term, 20% with indexation. Hybrid funds depends on equity percentage. If equity percent is greater than 65%, then equity rules apply. Otherwise, debt fund rules apply. Also, choose direct plans. Uh, uh, Here, read the name carefully. Don't go with regular plans. Go with direct plans. They will say 1% annually compared to regular plans. Now let's see systemic withdrawal plan versus fixed deposit for retirees. Here, fixed deposit gives 5 to 7% fixed returns, but mutual funds returns may vary from 6 to 9%, 10% based on the market. Liquidity FD, if you are exiting early, then penalty will be given. Whereas liquidity in SWP mutual fund, it is flexible withdrawal. Tax interest taxed per slab in fixed deposit, whereas it depends on capital gains and also often lower compared to FD. Flexibility is low here, flexibility is higher. SW gives better tax efficiency plus flexibility for retirement income. How to select the right funds? Now let's see various funds and how to select it. Equity funds. Prefer diversified over sector or thematic unless expert. See, go with diversified equity funds over sector or thematic, because if you are going with sector funds like pharma mutual fund or software fund like that, then if that sector is not performing, then your money is at stake, right? So prefer diversified fund. Debt funds sticks to short duration low credit risk funds. Debt funds does not have much credit risk compared to equity funds, because these invest in repos and short term government bonds, right? So for shorter duration, go with debt funds. And even your emergency funds can be parked here, as these are low risk. Hybrid funds great for auto balance plus conservative investors. Index funds ideal for core portfolio, low cost passive. If you are not able to select which fund is right for you, you can start ideally with index fund, because these invest in indexes. Plan type direct plans save 1% annually versus regular, so don't ever invest in regular funds. 5 portfolio mistakes to avoid: having 7 to 10 funds of the same type, example 2 or 3 large cap, 2 or 3 small cap, etc. No debt allocation for short term goals, chasing last year's top performance blindly, ignoring expense ratio and exit loads, mixing direct and regular plans in same portfolio. See, regular plans, these can be used in only one case. If you can afford some expert to choose the funds for you, then go with regular plans. But he should be registered by SEBI, that that person or a company should be registered by SEBI, and he should be helping you to pick the funds. Then only you can pay 1% of the invest amount, right? Otherwise, just by choosing regular funds in apps doesn't give you any benefit. Now let's see important cautions. Over diversification will give index like returns. See, if you are over using more funds, then you don't get returns more than index. Too many sips is tracking headache. Don't panic on short term NAV dips. Evaluate consistency over 3 to 5 years, not just 1 year. International funds taxed as debt plus currency risk is also exists for international funds. Nominee is not legal here in mutual fund portfolios also. See, your ideal portfolio formula should be based goal aligned, risk matched to life stage, simple to manage, tax efficient, and it should be reviewed annually. Keep it clean, avoid over engineering, match your life stage. See, now you should be ready to build your portfolio. Thank you.